So being able to purchase homes without having to qualify with your income every single time is going to be important when it comes time to purchasing multiple investment properties. And there's an actual loan that is used for this, and it's called a DSCR loan. Most people have never heard of that, but what it basically is using the income, the future income from the property that you're going to buy to cover the mortgage payment, and you don't have to disclose any of your own income. The property sustains itself. So the actual definition of a DSCR loan is a debt service coverage ratio mortgage. And in the definition, it says it's a type of mortgage that allows borrowers to qualify for a home based on the cash flow of the property rather than their own personal income. And that's a big deal. And so what you're also seeing right here is this DSCR loan is also known sometimes as a non-qualified mortgage, non-QM, or sometimes you'll see that it's called an investor cash flow loan. So that's what we're basically talking about. And as you look at DSCR loans, you will have to know that the interest rates are going to be slightly higher than the market. And not only that, but there's all kinds of different things that are not normal loans. But let's go through the guidelines so you fully understand what you're looking at. Credit score does determine what you can qualify for. Basically, the lower your credit score, the more money you're going to have to put down. You can get a DSCR loan with as low as a 660 credit score, and that's going to be 30% down, a 70% loan. If you were purchasing a $400,000 house, you would put $120,000 down. And if you had a 680 credit score, you could put 100 down, and a 720, you could put 80 down. 80 is 20%. That's really what you want. You want to be able to put 20% down on this property, and that's going to give you the lowest down payment. There are some exceptions where people can put less money down if the circumstances are perfect, but most people are never going to come across a situation where they can put less than 20% down without doing their income. And that's what you're looking at right here on the DSCR loan. The next thing is you have to look at loan amounts and understand what's going on. You can't do this for less than $100,000. That's pretty much the lowest that a DSCR loan will be. And you can go all the way up to 2 million. And in fact, you can even go up to 2.5 or 3 million in some cases. But to get the best rates, you want to be typically between $100,000 and $2 million. But you can see at $1 million loan, you have to put 20% down. If you borrow 1.5 million, you have to put 25% down. And if you borrow 2 million, you have to put 30% down. Most of the people that are doing these loans are purchasing properties between 100,000 and $1 million. And so it doesn't really come into effect. And if they have that 720 score we just spoke about, then they're really just putting 20% down. But the credit score does affect how these DSCR loans work out. You have to understand the actual qualification part of the rental income. In an ideal situation, what's going to happen is the rent is going to exceed the mortgage payment. If you look in example 1, you can see the rent on this hypothetical property is $2,000 a month, and the mortgage payment is $1,800. So that is perfect for a DSCR loan. And what you're going to find in that case is you're going to get the best terms. Example below, the rent is $1,800 and the mortgage payment's $2,000. You're actually collecting less money than the mortgage payment. You can still do that, but when you do that, what's going to happen is you're going to have to put more money down. And a lot of times that fixes the problem, but also you're going to end up taking a higher interest rate. And you can see it's 0.75. What that basically means is, in theory, you could be receiving as low as $1,500 a month in rent, and the mortgage would be $2,000. It's still possible to do it, but the payment's going to be significantly higher because you're at a deficit as far as cash flow. And there are no ratio DSCR loans too, but these also require larger down payment and higher interest rates. Ratio is really important in terms of qualifying, not only the credit score, but this is how they determine the income and qualification. Next thing is your credit. When you do this, really ideally you have 0 lates on your existing mortgage. This is your primary residence. You can have a one-time study. That means you've been late on your current mortgage one time, but all of a sudden the loan to value is going to drop all the way to 60%. In this case, you're going to have to put 40% down because you've had a late on your mortgage. What they really want is people that have had no lates on their existing mortgage. This makes you a much better risk in terms of qualifying. You can have 2 of these properties, so you can build a whole portfolio. If you can find the properties and come up with the down payment, you can legitimately have 20 of them. And you could 1, 2, 3 but really you're never going to have to show your income all the way up to 20. That's a pretty substantial amount of properties. The normal Fannie Freddie guidelines will limit you at about 10 properties. And you don't have to hold the title in your name. You can obviously hold it in your name as an individual. You can hold it in a business's name. You can have limited partnerships, general partnerships, corporations, LLCs, and trusts. There's a lot of ways you can hold these properties. Some of the investors have each property in its own LLC, and that's totally possible with this. Not everything has to go in your name. When you pull your credit, you see 1 million mortgages. What ends up happening is you can have it in the LLC, and there's some other protections, but you really have to make sure that what you're doing is in line with your ultimate goal, and really important to talk to an attorney to make sure that it's working for you, because those LLCs sometimes are not the right way to go. But if you want to do it, you can do it that way. You can be a first-time investor, so this means you've never bought an investment property. However, if this is the first time you're buying a property, their DSCR rate would be below 1. What that means is that the rent that you're receiving for that property has to be more than the mortgage payment. Like that example before, if you're receiving $2,000 in rent, the mortgage payment has to be less than that. And if this is the first time that you're doing this, you also have to have a 700 credit score. There are some, specific home buyers that they have to do in order to be able to qualify, but you can be a first-time home buyer. You can buy a non-warrantable condo. So this is interesting. What a non-warrantable condo is this is where there's some delinquencies going on. And what I mean by that is typically it's more than 15% of the people that live in that development are more than 60 days past due. So a lot of times you might say, well, why would I want to buy into a condo development where people are not paying their condo dues? And there could be a variety of reasons that this is going on. But the reason why sometimes people want to do this is because those condos typically sell for significantly less, because it's much harder to get an FHA loan, conventional loan. You find a lot of investors in there. Now, because it's non-warrantable, it's much more high risk for the lender in terms of, just the condo and that kind of stuff. So they do want you to put 25% down, but you can buy a non-warrantable condo. And that's important to know, because a lot of loan programs won't allow you to do that. The different types of loans you can get: a 3-year ARM, a 5-year ARM, a 7-year, a 10-year. You can get a 15, 30, 40. You can even do interest only. And sometimes when it comes to cash flow, people want to keep that mortgage payment as low as possible, but you do have to have 700 credit score to do an interest only. And it's a slightly lower LTV. Most likely your first one of these is going to be a 30-year fix, because people keep it pretty simple. But as you get deeper into it and you're buying property 5, 6, 7, 8, 10, 15, there might be reasons why you want to change the product. So it is available to you. We have to talk about that to make sure we're doing the right thing when you do that. You need some reserves. After you close, you're going to be putting out a large down payment. If the mortgage is 125 to 500,000, you're going to have 3 months reserves. And if the mortgage is between 500,000 and 2 million, you're going to have 6 months reserves. And what reserves are mortgage payments. If your mortgage is hypothetically $2,000 a month and you need 6 months reserves, you have to have $12,000 in the bank after you close. That's after you've done the down payment and closing costs. There has to be at least 6 months mortgage payments in your bank. So it's just something to be aware of, and you'll need a little bit of extra money. But ultimately, you become a professional investor when you use this program. So you do need some reserves. Your credit has to be pretty substantial. Each borrower's credit profile must include a minimum of 2 trade lines within the last 24 months. So that means that you have to have these trade lines that have been open 24 months, and they have to show at least a 12-month history of being used. And if there's more than one person on the loan, then the combination of the 2 borrowers, you have to have a minimum of 3 trade lines. You can't just do this if you don't have any credit. You have to establish a couple trade lines. You have to have them open for 24 months. And then you have to have a 12-month history of using these trade lines on a regular. Credit is going to matter in terms of how you get this loan. We're going to have to do appraisal. Only one appraisal is needed below $2 million. On the appraisals, what happens is the appraiser system into something called CU, it's collateral underwriter, and it assigns a score. If your CU score is above 2.5, that would be considered slightly higher risk. And when it's higher risk like that, you have to get an appraisal review. And most of the time, what we're looking for is the review to come back within 10% of the original value. If it comes back within 10%, then you're good to go. So let's suppose hypothetically, the property you're buying appraises for 500 and the CU score is 3.5. That's going to require the second appraisal. And let's suppose the appraisal review comes back and it appraises for, I don't know, 480. So that's within 10% of the initial appraisal. And so you're good to go, no big deal. But it's important to know if there's some question about your appraisal. And a lot of times people will consider what they want to do in terms of going forward when they get a high CU score. It's important to know what that score is in the process. You cannot use this on rural properties, so you need to kind of own that. And even if the property is not rural, you can't use this on properties that are more than 10 acres. It just pretty much eliminates them right from the get. So that's important when buying these properties. These mostly are rental properties, and most people don't buy investment properties that are rural or that have a ton of acreage. It's more of a situation where people purchase it for themselves. Sometimes you do see that. Credit events, significant credit events. You cannot have bankruptcy or a foreclosure or any other significant credit event in the last 4 years. They're looking for clean credit for at least 48 months. And if you find that you've had these stuff, then this is not going to be the loan for you, because sometimes you can get an exception on this, but it would mean you're putting a ton down. And typically it would be better for you to wait for those 4 years so that you can do this, like a regular loan. This is interesting too. You don't have to live in the US to do this. You can be a foreign national. You can have an ITIN number, which is just a tax ID number. There are some additional overlays and slightly higher rate, slightly more down, but sometimes people that don't live in the US want to purchase an investment property, and they can do that. And so you don't have to have the social, and you can have a tax ID, one or the other. We have to look at that case by case, but it is possible. All these loans, they have cases people don't quite fit in the box in terms of what the guideline is, what the credit score is, what the LTV is, but maybe they have a ton of cash, or maybe they have really, really good credit, or maybe they have something else which can be used to create that exception. If you don't exactly into the guidelines, it's always good to ask. Now, if you don't have something to compensate, then you're not going to get the exception. But if you have something to compensate that can pretty much, people can look at it and go, okay, this makes sense, then it is possible. The DSCR loans are a great way to start building a portfolio without having to prove your income every single time you purchase a property. And you can go from 1 to 10 to 20 loans. And really, it can get done. You just got a good process. And after you do the first one, you'll see it's relatively easy.